Good day. This is Patty Membrebe, Metrobank Financial Markets Analyst, here to share some of our latest trade ideas in the peso government security space. In our previous update, we cited three catalysts that could prompt an uptick in both US and peso yields: the deluge of supply of US Treasury bills, a repricing of further Fed rate hikes, and bond supply risk in the local space. We also reiterated our preference for short and longer term peso bonds at our target levels to take advantage of elevated yields. As uncertainty surrounding these aforementioned risks have eased, we continue to see buying opportunities for investors in peso bonds. A barbell strategy for peso government securities is still recommended. We like short term bonds with 1 year to maturity, as well as the long ends, particularly 10 years and beyond at tactical entry levels. Inflation expectations have increased, however, following the higher than expected August Philippines inflation print, which came out at 5.3%. This was higher than the 4.7% consensus estimate, and it reflected a 1% month-on-month increase. As a result, we've revised our full-year local headline inflation forecast to 6% from 5.6% previously for 2023. Upside risks may linger through early next year, particularly from imported rice, oil, and other possible second-round effects. That said, the BSP expects Philippines inflation to ease back within target by next quarter and has signaled that it does not see the need to raise rates again if there would be no other supply shocks similar to what we saw in August. In the US, August inflation also slightly surprised to the upside, with headline inflation printing at 3.7% versus 3.6% consensus forecast, higher than 3.2% year-on-year in July. Markets continue to anticipate that the Fed will hold rates steady when it meets on September 21, but Fed funds futures indicate that the markets have priced in a 44% likelihood of a Fed rate hike in November. Our base case is that the BSP will keep rates steady until year end, but as upside risks to local inflation linger, and as there is a non-zero chance the Fed will deliver one more rate hike this year, we continue to advise investors to remain opportunistic buyers, especially on sell-offs. Looking ahead, we think that peso yields will continue to trade within recent ranges, and our view of falling peso rates in the medium term remains intact. We cite three catalysts that would keep peso yields supported in the near term. First, the market remains awash with cash. We estimate that excess system liquidity is currently at around 1.63 trillion versus the 480 billion pre-pandemic average. We also anticipate these excess funds to continue to flow into peso bonds. This has been magnified by the recent jumbo maturities, over 140 billion in August and over 143 billion in September. Reinvestments from these maturities have capped the rise in peso yields. For instance, the 10-year peso yield is now around 5 basis points lower from 2 weeks ago when the market turned defensive and peso GS yield sold off by as much as 12 basis points following the upside surprise in local headline inflation. For now, with no jumbo RDB to siphon off these investable funds, we continue to see support for peso yields. Second, we see less bond supply risk as the Bureau of the Treasury continues to be ahead of its domestic borrowing program. Our estimates show that as of end August, the BTR has covered 97% of its planned gross domestic borrowings. This puts the government in a good cash position, and we expect the BTR to cap its awarded yields in the remaining weekly T-bond auctions through year-end as a result. Lastly, although local fundamentals and external risks point to higher interest rates for longer, our view is that the BSP is likely at its peak tightening. The BSP's combined 425 basis points of rate increases since May 2022 has started to weigh on the Philippine economy, as evidenced by the disappointing Philippines Q2 GDP. We therefore maintain that the BSP will look to cut rates next year, barring further supply shocks to inflation. For their sizable term premium pickup, less cheapening pressure from bond supply, we like the longer tenor buckets to lock in elevated yields and to maximize gains when interest rates fall. We like 11 to 12 years at 6.35 to 6.45, 15 years at 6.5 to 6.6%, 20 years at 6.575 to 6.725. Hold to maturity investors may also find current short-term yields attractive, in particular the 1-year peso T-bill and the 6-month RDB 3-11 and RTB 5-12 at 6% to 6.1%. Thank you and see you again in our next update.